Hi, everyone. My name is Phil Blancato, and I'm CEO and President of Latimer Thalman Asset Management, Chief Market Strategist for Rose. Welcome to another weekly market impact. Well, I'm a bit under the weather, and I'm usually never sick. Sick is a very rare thing for me. I just don't ever get sick, and I am sick. Fighting it tooth and nail, trying to get as much sleep as possible. But I wasn't going to miss an opportunity to spend some time with you all. So forgive me for the hoarseness of my voice. Hopefully, it's going to come through okay. I'm trying my best to get back on my feet here. I didn't even do a good job cleaning up behind me today. Sorry if it looks so messy. I'm trying to get my act together this morning, and at best, I'm just hanging in there. But I'll be fine. I'll be fine. You know, it's that time of year. I mean, cold, 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 cold. It's cold outside. We have been below freezing for 14 days in a row. We're going to warm up to 32 3 days this week here in New Jersey, and then go right back down to even worse we were. I am seeing areas of New Jersey frozen that I've not seen frozen in a long time. For example, there's this famous cove in South Jersey. It's called the F Cove. It's a long story, but if you look at it from a drone or a helicopter, it's an inlet. It's a canal that's carved like an F. And the reason why originally it was going to be we were going to build homes on this, and there were docks or something like that, and then it never happened. So today, a lot of boaters go there in the summer and they dock and they hang out all day long, and it's fairly big. It's probably the long arm of the F before the sides go off. I don't know how you describe that. It's probably 300 yards. And then each kind of the top of the F, the middle of the F is probably 300 yards. So these long canals where boaters go hang out and they dock and they play music and they have a good time. That canal, which it's salt water. This is the Bay of New Jersey, frozen. The canals of where the houses are, famously along the Jersey Shore, the coastal, frozen. My partner Jamie Desmond has a house down there, and one of the canals, they're playing hockey on there. Now, that sounds like a terrible idea to me, because what if you fall through? But, excuse me, it's frozen. And my daughters down in Athens got a few inches of snow. They were literally out on Saturday night, and the kids was having a few drinks, I guess, sliding down the streets on black ice, falling on their butt, wiping people out at midnight. This is goofy. And where I'm at, I mean, it's just the Passaic River, which is a very rapid river. It's got real flow to it. It is the dirtiest river in the country, but that side has is frozen. This is not a river that freezes very easily. So this is a real winter. This is legitimate. I mean, I think I was watching the news last night, and other than 2 days in the month of January, we were below average temperatures. For curiosity, I did Google, have the ice shelves increased at all in the Arctic or the Antarctic? And it sounds like Antarctic is kind of ebb and flowing a bit worse recently, but nothing terribly significant, whereas the Arctic is much worse. And let's hope that, for all the concern about ice shelves and, increasing water temperatures, as well as the amount of water in the ocean, which then could lead to catastrophes, like you just saw in Sicily. Sicily had a really tough time where large portions of Sicily got hit by a bad tempest. And that tempest really kind of wiped out the coastline south of Taormina, really terribly, but real terrible. That I get it. Storms have always been around, so let's not get into the debate about global warming. But you would assume that if there's more ice because of these cold temperatures, that's better. I guess I don't know. This is not, I really like weather. I've always been a fan of weather, and I look at it, especially for economics in the United States where droughts are. But certainly something to think about. Anyway, my favorite picture that I saw over the weekend was this picture from Florida, where they went out of their way to encase blueberry plants with water, because then the freezing temperatures, the wind specifically, wouldn't affect them. So there's these groves of blueberry plants covered with thick ice, and as it warms up, they got to knock the ice off to uncase them. I mean, this stuff is goofy. We haven't seen this in a long time. Down south, where I have a lot of friends in the south, and they were complaining they haven't had snow in forever. Well, they've got plenty of it this year. In the Carolinas, Charlotte specifically had half a foot of snow. So who knows? I guess weather comes and goes. Hard to say. We saw a lot happening last week. Oh, by the way, the girls down in Athens had a day and a half off of school and decided to do laundry. Just to get a kick out of that. Oh, my voice is terrible. Forgive me. Hold on. It was better. I was doing much better. I haven't used it this much in a couple of days. Hopefully, I sound okay. All right. I'll try and make it relatively brief today, but there was a couple things that they hit on. First off, the one thing I saw that was of quite interest to me was for all the euphoria around gold. There's been a lot of gold euphoria. What happened on Friday was fascinating to me. On Friday alone, both gold and silver got walloped, and we're talking trillions of dollars exited both of them. Gold was down, about, let me look just to double check it. I want to say 20% on Friday, and silver was down almost 50%. I gotta get that number right. I might have that number wrong. I don't really spend a lot of time on gold and silver, but I was watching the price action. Silver prices plunged 31%, the sharpest drop since 1980. Quite incredible. And gold plunged 11%. So the reason why I make that point is because you never know. Geez, sorry. You never know when you buy into speculative asset class, cryptocurrencies, gold, silver, things that are anti-currencies generally they're going to come with lots of volatility. The reason why gold sold off was simply because you have this scenario where there's an announcement on who the next Fed chair is going to be. And the next Fed chair looks like it's going to be Kevin Warsh. And to be honest with you, I think that's a pretty amazing pick. Because while I like Kevin Hassett a lot, Kevin Warsh does bring to the table kind of a no-nonsense, pragmatic approach to being the Fed chair. And I do think he's going to be a data-dependent guy. Not that Hassett wouldn't have been a good guy. He was a bit of a wild card. Warsh is been around the Fed for a long time. He's been waiting for this job for the better part of 10 years. And while he wants lower rates, that's something he's very intended on. He also wants a smaller Federal Reserve balance sheet, which basically means the Fed gets out of the way. So what the Fed out of the way, what generally happens is the dollar strengthens. So if the dollar gets stronger, because it's no longer influenced by the Federal Reserve, no longer printing excess money, well, then you have a scenario where the dollar strengthens, and guess what? Gold and silver get walloped. The counterpoint to this is what's happening in Japan. Japan, for a while now, has been trying to get their inflation higher. Well, the problem with getting inflation higher, it could get out of control a little bit. So as inflation got a little bit higher, the people who live in Japan started to complain that food prices got too expensive. So the government had to step in and take away taxes on food. It was the first sign that their attempt to get inflation higher. The reason why they want inflation higher was they haven't had any real growth in Japan for the better part of 20 years. So they're trying to spur growth, spur inflation, and get the economies doing a little bit better. Well, ultimately, what it meant was that suddenly it was working, that inflation was going a bit higher because they were printing and stimulating more money. The problem was it started to get a little bit out of control. So now they put in controls to try and limit the amount of inflation. Well, what does that do? It put a scare into the system. Japanese bond yields went higher because people want to be paid more to buy into a speculative bond market, and the Japanese currency fell apart. Goes to show you how fragile this whole environment can be when you start manipulating currencies, when you try to do things that are not normal. Well, then when you get out of the way, the traditional, getting in the way of market imbalances, trying to manipulate markets, bad things can happen, just like gold and silver. So with the United States potentially getting out of the way, no longer being a stimulant to market, it means the U.S. dollar strengthens. Well, that's fascinating because that's not what President Trump wants. In fact, the dollar right now is at a 4-year low. And the reason why he wants it a low because it makes American manufacturing more impressive, exporting more impressive. In fact, today we got a really impressive number. What we saw today was when we measure ISM manufacturing, and ISM manufacturing is a very important tool because it tells us the strength of the U.S. economy when it comes to making stuff. Now, making stuff is still only 11% of the U.S. economy, but you still would love to see this an expansion, especially because there's a great story about how Eli Lilly is building a GLP-1 factory in Pennsylvania. It's going to employ around 8,000 construction workers, about 1,000 longtime workers, all of them with very high starting salaries. Instead of making GLP-1 drugs in Ireland, we're going to make them here in the United States and export them. It's a great story. Why? Because this is a byproduct of the big, beautiful bill. The ability for Eli Lilly to build that plant and immediately deduct it all from their taxes. So in that scenario, could we get a revival in manufacturing? Well, guess what? ISM manufacturing has been in contraction for the better part of 5 years. We haven't seen really any growth there at all. And this month, the month of January, the number crushed it. ISM manufacturing increased to 52.6. Anything above 50 is considered expansion. And the number was expected to come in at 47.9. Basically, what it means that we grew manufacturing. Now, here's a caveat. Normally, the month of January is a good month. Normally, the month of January suggests clearly that when it comes to ISM manufacturing, usually it's a better month because you get inventory restocking, you get a rebuild post the holiday season, you get the expectations set up for the coming year. But production was up to 55.9. New orders up 57.1. Employment was still in contraction at 48, but inventories at 51 and supplies deliveries at 54. All those far beat expectations. You won't see the employment number grow until we see real growth of manufacturing. But it tells you that, you never can just bet on something being permanent. So the moving goal was expected to be, double from here. The goal was going to go higher because the U.S. is printing too much money, because Europe is printing too much money. Well, guess what? Europe might grow at 1.5% growth rate in 2026. They won't have to print if that's the case. Japan has got its issue right now. I mentioned that. But if we grow at 4% GDP, which is we did 4.4% for the third quarter, we may do 4.5 for the fourth quarter. Now, the first two quarters of the year were weird. So for the year, we'll still only do about 2.5%. But if we get manufacturing growth and the consumer hangs in there, then the dollar strengthens and gold and silver get walloped. So my point is the nomination of Kevin Warsh is a big deal. When I think about what that meant is that there's confidence in the U.S. economy. And so far, from what you can tell, it looks like the confidence is going to be rewarded. Now, Kevin's not in an easy spot, though. The president wants lower rates. And I'm not certain you're going to get lower rates unless you have a scenario where, in fact, all of a sudden, we get lower inflation and we still get production. And if that's the case, great, good for him. But what if we don't? What if, because there are real trade agreements happening between India and Europe, China and India, Canada and China, uh, Europe looking for new partners. If there's a world where, because they get angry with Trump, they try to avoid Trump completely, to avoid the United States, and suddenly the tariffs don't work as they expected they were to work, which I find that hard to believe because everything's still traded in dollars. So it doesn't, I'm still not convinced that's going to happen. But reality is, in a world where the rest of the world kind of avoids us, you may not be able to import deflation. You may not get that lower inflation rate. And if you don't get that lower inflation rate, then Mr. Warsh can't cut rates. Because right now rates I think are a bit high. 3.5% makes sense to me if inflation was at 3.5%. But with inflation down around 2.75, I would argue the Fed funds rate should be, in the borrowing rate, the front end of the yield curve should be 3%. So it probably has two cuts in them this year. But beyond that, I don't think a heck of a lot more, unless you get substantive lower inflation. And how are you going to do that? Well, you got to import some deflation. Technology is deflationary. Demographics are deflationary. But I think ultimately you have to be in a scenario where you have to ask yourself, are we right now at where we should be on the Fed funds rate? And it's why the dollar hasn't really fallen apart, because arguably it's pretty close. So I wish Mr. Warsh good luck. I appreciate that he's an inflation hawk, not a guy that wants to manipulate markets with the Federal Reserve. But this is not an easy job. I know I wouldn't want it. That's for sure. Being yelled at by the president on a regular basis would be not fun. All right. So anyway, enough about Mr. Warsh. We got some consumer confidence numbers last week, and they were not great. They were, once again, consumer confidence is very weak. Now, it's a bit along party lines. And we look at consumer confidence among Democrats. For every 10 you ask, 4 say it's good. Call it 6 say it's terrible. For Republicans, about 7 say it's good, 10 say it's terrible. 3 say it's terrible, which is a very good number, by the way. Independents, which is the big one, about 5 out of 10 say it's terrible, which if you lose the independent block, then you have a scenario where the midterm elections are very much in jeopardy. And just this weekend, another seat went back to the Democrats in Congress. And this one was in Texas. So clearly, what's happening with ICE, I think, what's happening with the perception of tariffs, is hurting the president. And if the president loses the midterm elections, what does that mean for Venezuela? What does that mean for tariffs? What does that mean for a lot of what he wants to do going forward? Not to mention arguments from the Supreme Court and what he could do or not do with tariffs. It'll be a fascinating year politically and what happens next. But Warsh is a big step in the right direction, at least getting us kind of, to some degree, less worried about what's going to happen next with the Fed. We now know the path. Whether it's going to work or not, well, we'll see. We did get information on Producer Price Index, otherwise known as PPI. I don't spend a lot of time on it because it's a very volatile number, but it does suggest the cost to make things was hotter than expected. Again, not a great thing. PPI rose by half of 1% in the month of December. We're expecting it to rise by zero point 0.3. Even core PPI rose zero point 0.7, and that's with food and energy have been all over the place. Energy especially have been pretty expensive. While gasoline prices are down, natural gas has been higher because of the cold snap. So that's a little bit funky. But I would say that that's a concern. When you look at that number, that's going to be hard for If this is a trend, hard for Mr. Warsh to get his way if, in fact, that trend continues. When I think about where we are in markets and what's happened so far this year, it's definitely been a widening of the market. There's no doubt. For example, small cap stocks continue to do really well. They had a tough week, down 2%, but still up 5.35 on the year, where the S&P 500 is up 1.45. So clearly, small caps have been the winner. Even with a risk-off week like last week, it hurt them. They probably went a little too far, too fast. The Nasdaq, for the euphoria around the Mag 7, only up 1%. The S&P is beating the Nasdaq by quite a bit. So there's concern that those big AI names have just come too far, too fast, that we need more growth to justify them. The winner so far, emerging markets up 8.8%, and international stocks about the same as small caps, about 5.2%. So non-dollar investments, some of the things I mentioned, trade agreements in other places, a weaker Japanese yen, a weaker US dollar, are going to drive offshore investments. It's just the way it works. And in the end, if Japan can't get their fiscal house in order, those stocks are going to get clobbered. Probably some of that money will come to the United States. But certainly, when will the world finally wake up to the amount of debt that we have? When will the world finally realize that you have to stop borrowing? And the United States is treading a fine line. We have the most debt of any country in the world. For every $1 we spend on interest payments, we generate $5 in revenue. Think about that. For every $5 in tax revenue, $1 goes to interest payments alone. That's not great. That's not something you can sustain. So while the market so far this year have been good, there's a January effect. As January goes, generally the year goes. So it would tell you that the S&P could very well have a positive year this year. But certainly when I look at other markets, the broadening out of markets, it makes great sense to me that you could go in other markets and do quite well. So for us, whether it's being in small caps, adding international, thinking about commodities as a place to be, those are all very interesting areas for us that we think may be a fabulous place to invest over 2026. Why? Because the rest of the world's kind of figuring out what to do with tariffs. Their economies are growing well enough. Trade agreements between other countries. And let's just call it what it is. While we're the biggest gorilla in the room, and other countries have to have us as a trading partner. If they don't, they won't grow as much. There's other things they can do to grow around us. So hopefully there's a kumbaya moment for the current administration, as well as the rest of the world countries to come to some resolution, whether it's South Korea, which is back in play, India not yet resolved, Europe not yet resolved, and what the Supreme Court might do. It could be a fascinating year to find out about that. But for now, the data still suggests that things are good. U.S. GDP growing well enough. So far, earnings data have been pretty good. We have a big week of data coming out. We're going to get payrolls on Friday. How's the job market doing? That's a big concern. How are JOLTS doing? The number of open jobs. We expect that number to increase as there's more jobs available. The Federal Reserve met last week and did not change interest rates. Why? Because inflation hasn't come down enough. So the Fed's not helping out the market, yet the market's still up. If the labor market hangs in there, and so far earnings season has been good enough, the market should hold on here. But to suggest that we won't get a correction would be silly. I think we will because stock valuations are far too expensive. And then go beyond that, I think you got a chance to broaden out your portfolio. The equally-weighted S&P 500 is actually beating the cap-weighted the S&P 500. Not bad. The bond market's flat. We're not really getting much out of bonds yet. Why? Because we don't know what's going on with the Fed, and we've got too much debt. Bond yields won't go lower until ultimately you have a scenario where the Federal Reserve finally it doesn't have to cut interest rates anymore, and we see inflation come down simply because we're in a deflationary world. If that happens, and the U.S. economy hangs in there, then rates could go a bit lower, but I wouldn't think a heck of a lot lower. I'm still in the camp that the Fed funds rate ends up at around 2%. I mean, to me, that makes the most sense. So I put it all together, and certainly it was a good week. Not the best week for stocks. I mean, when you think about what we did for the week, S&P up 0.35, Nasdaq down 0.16. I guess that's small caps down 207. The risk-off trade hurt a little bit, but we're in this kind of moment of waiting to see what comes next. The Fed's not helping. Earnings are good enough. U.S. economy is good enough. Trade agreements are still in kind of in flux, but ultimately, it seems like we're kind of getting there. We're just assuming it's been more of the same. Okay, what does that mean? Be diversified. Go into other portfolios, other asset classes. Excuse me. And by the way, the bond market is beautiful again. Nothing wrong with owning bonds here. I think long-term yields come down, and for that reason, why not have some bond exposure in your portfolio to earn some wonderful yield, and at the same token, to a degree at least, you have some safety in your portfolio. Okie dokie. That's a lot for this week. Had to get through it. Hopefully, you didn't. Hopefully, you can hear me and I'm clear enough that this makes sense. I was doing pretty good this morning, but my voice is kind of going. I got to do Fox Business later today. I hope I'm not terrible at it because I was doing good up until a few minutes ago. All right, just one couple last fun points. I saw a fascinating research report on how businesses are manipulating Chat GPT. And the reason why they're manipulating is that they want the outcome for their products to be more favorable. So they're spending millions of dollars to try and make the output of ChatGPT suggest something other than what it would have been without them spending the money, whether it's on marketing or data or different observations that it might make, or ways to paint their company in a favorable light. So right now, we're looking at in 2025, it's kind of a phenomenal number. When you look at growth in generative AI platform referrals, so referring data to a ChatGPT was up $250 million last year. So in other words, companies spending money so the output that ChatGPT or something else would suggest is favorable. That's terribly dangerous because we're going to these things for a non-biased opinion. What happens if chat boxes have a biased opinion? Well, that's terrible. That's not what it's supposed to be for. That's not the point of all this. So I'm very concerned about that, and I would hope there be some regulation around that. This is what I mean about AI. AI's got a long way to go. Whether it's the data that you need or the power that you need, the adoption rate. A lot of young kids are saying they don't want to use it because they fear for how much it hurts the U.S. The environment, that it drains so much more power. Remember, for every click on traditional internet versus the click on ChatGPT or a large language model, 10 times more power. So in that sense, wow, that's a big deal because if that's the case, then the reality is that people are worried about the environment. They may not use it. Can you imagine that? They may not use it because they're worried about the environment or electrical costs of 18% year over year in New Jersey. Now, it's not totally because of data centers, but partly it is. So I think there's a lot more to come in understanding what happens to regulation around AI. All right. My shout out of the week goes out to Catherine O'Hara. Maybe you don't know who Catherine O'Hara is. She's the mom from Home Alone. She was in Beetlejuice and she was in Schitt's Creek. And I'm sure everyone knows who she is now. She passed away. God rest her soul. One of my favorite actresses. Funny, entertaining. I never heard of her get involved with politics. I don't like when actors and singers do. I just think that's not their place. Just my opinion. But I thought she was a great actress. So my shout out goes to the people that make us laugh, that entertain us. Catherine O'Hara was one of them. I loved Home Alone. I'm sure you did too. And I loved Beetlejuice. And Schitt's Creek was hilarious. So hats off to Catherine. One fun point. I still believe the world comes back to economics. At the end of the day, if your economics are good, everything's better. The New England Patriots are going to make the Super Bowl. They're in the Super Bowl. And why are they in it? Economics. Because they're being the biggest gorilla in the room. They spent $500 million. $500 million in the offseason to rebuild the franchise. And by the way, I don't think they're going to win. I think they're blown out. I don't think they belong there. They had a lucky path and it worked out for them. But they built a team based on spending money. So in the end, if you have your good family balance sheet in good shape, you make sure you mind your P's and Q's, you spend your money appropriately, you can have a darn good life. Because in the end, when the U.S. economy is good, we get people making more money, less anger in the country. You can take this thread into any business, any industry you want, any social environment. When economics are good, there's a lot less things people be angry about. But I thought the Patriots are another example of sometimes the money you spent and spent wisely can pay gigantic dividends. And with that, I wish you all a wonderful week. Stay warm. I promise you I'll be better next week. Sorry for my hoarse voice. Have a wonderful week, everybody. I'll talk to you all soon. Bye-bye.